Just 4 days into his new administration, President Donald Trump has hit the ground running faster than any president in modern history. Now, until now, the Fed has been the most dominant factor with their interest rate policy, primarily in response to inflation rearing its ugly head in 2022. The question is, going forward, who will dominate? Will it be the Fed with their interest rate policy or the Trump administration with all of their new policies and objectives for making America great again? Meanwhile, gold is testing all-time highs. In this gold market commentary for January 24th, 2025, we'll take a look at what's been happening in the markets, primarily with the dollar, inflation, and interest rates, and of course, precious metals. And we'll drill down on why the Trump administration will trump the Fed in 2025. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We're a national physical precious metals dealership. If we can help you with any of your physical precious metals needs, we'd love to have that opportunity. The U.S. economy and employment remain resilient, but inflation remains stuck. U.S. economic growth continues to remain superior to almost all other countries. This is why the Trump administration will have a greater influence on markets than the Fed in the first half of 2025. The U.S. economy is leading all other economies, and the Trump administration's new policies will affect the markets more than the Fed will. And that's, of course, their policies of deregulation, spending cuts, and tariffs, which are going to make a difference. And the Fed has basically sidelined themselves with their interest rate policy as of their December meeting. So let's take a look at what's been happening with the U.S. economy, what's been happening with the dollar, what's been happening with rates, and get into our charts. I think the main reason Donald Trump is able to hit the ground running so fast in the second term as president is primarily because he had the 4 years between his first term and his second year to process what happened during his first administration, to plan, and to prepare for becoming president again. Most presidents, if they're reelected, they go straight into their second term with no break, no pause to process, no time to think, no time to reset, and no time to really plan. President Trump has been the beneficiary of all those things during the last 4 years. So when he became president for the second time, he knew exactly what and how to do what he wants to accomplish, which is why he's hitting the ground running so fast. And with the Fed basically saying, hey, we're going to pause with our interest rate reduction cycle, and we may only cut rates maybe one time or two times this year, they've basically neutered themselves. So this is why the Trump administration and their policies, and primarily the tariffs, which they may or may not deploy, and how fast and furiously they may do this, are going to be the most influential factor in markets around the world. And not only the tariffs that we deploy, is how are the countries that we tariff going to react to the tariffs that we deploy. It's going to be a real chess battle, in my opinion. So let's drill down on what's been happening to influence primarily the precious metals markets, and that goes to the dollar and inflation and rates. The GDP for the U.S. has been very good. The Trump administration is inheriting a rather healthy U.S. economy. So this is one of the reasons why the Fed has decided to take a pause on their interest rate reduction cycle, is because GDP has been good. Employment has also been good. We got a blockbuster report for December with 256,000 new jobs created in December, which was high. The 12-month average has been 186,000 jobs a month, and the 3-month average has been 170,000. These are not great numbers, but they're pretty good. We do expect these job creation numbers to ease a bit going forward as the Trump administration reduces the size of government. Government is responsible for about 40% of new job creation. And as President Trump cuts jobs within the government, we'll see these numbers ease, and perhaps substantially. Time will tell. Meanwhile, inflation remains stuck. This is a chart of the Consumer Price Index and a call-out box showing how that has changed since August. In September, the CPI for the headline CPI was 2.4%, And now, as of December, it's 2.9%, a half a point higher. Meanwhile, core inflation has come down just 1/10% during the same period of time. So inflation remains stuck. And this is one of the reasons why the Fed has decided to hold rates a little higher for longer to fight this inflation resurgence. And you've heard a lot in the press about how the Trump tariffs are potentially inflationary, causing prices to increase for U.S. consumers. And even Jamie Dimon, the head of JP Morgan Chase, said the other day, hey, this is a fact of life. We're going to have to get used to it and live with it, especially if it's important for national security. So we do think inflation could remain sticky to stuck going forward, and it could increase due to tariffs. Time will tell, of course. This is a chart of the producer price index year over year, and you can see how it has moved substantially higher over the last year and a quarter. And this is what producers get for finished goods. And the Fed likes this because it's a little bit more timely than the CPI. So inflation fully remains stuck. And this, of course, again, will cause the Fed to ease in their interest rate reduction cycle. And we expect no decision out of them at the conclusion of their meeting on January 29th. So the Fed is going to go sideways and the Trump administration is going to go full bore forward. It's going to be an interesting ride. Okay, so let's get into our markets. This is a one-year US dollar index chart. And as you can see, in September, the dollar was at a low of about 100 as measured against a basket of other currencies. And it ran up in response to President Trump's potential win. Then after he won in November, it shot all the way up to 107.5, where it hit some resistance and then eased back a bit. And then when the Fed announced in mid-December that they would reduce the scope of their reductions in their interest rates going forward, the dollar caught a bid, and then it caught another bid in early January when we got that strong jobs report. So the U.S. economy is outperforming every other economy around the world, and the dollar has benefited as a result, punching all the way up to just under 110 on the U.S. dollar index for a 10% gain in about 4 months, which is a big, big move for a currency. And I would have expected, with the dollar at close to 110 and such a big move in such a short period of time, gold would have fallen under $2,500 an ounce, and that has not been the case. And now in the last 2 weeks, we've seen the dollar take a tumble back under 107.50 to about 107.3 today. And we can see in the 6-month US dollar index candlestick chart how the Trump administration's tariff policy has affected the dollar, specifically in December going into January 20th when he was inaugurated, and the reaction thereafter. Many economists expect inflation to rise due to Trump tariffs. And with that, the Fed could be more hawkish than dovish. And that's helped to buoy the dollar going into the presidential inauguration on January 20th. But because no new tariffs were announced on day one, the dollar took a tumble. And it's continued to tumble a little bit lower over the last 4 trading sessions, as you can see, back under 107.50 as we go into the close of markets on Friday, January 24th. So the dollar is weakening primarily because no new tariffs have been announced. And the fact that they're not coming immediately means fears of inflation have resided a bit, which has helped to undermine the dollar a bit. And gold is reacting to this weaker dollar. It didn't react to the strong dollar going up, but it is reacting to the weaker dollar going down. We'll get into that in just a second. So we're seeing a similar move in the 10-year Treasury yield as we have seen in the dollar. This is a 2-year chart showing the Fed funds rate and the 10-year Treasury yield. And you can see as of September, all the way into the Trump win, the Treasury yield increased to 4.46%. Then it subsided a bit. And the Treasury yield has gone higher over short-term resistance at 4.7% all the way to 4.8% before taking a bit of a tumble, following Donald Trump's inauguration. So the yield on the Treasury responded like the dollar did to the potential of tariffs, and now it's easing a bit. A lot of analysts thought that it would get to 5%, which hasn't happened yet, which is still possible. But right now, we've got the federal funds rate just under 4.5%, and the 10-year yield at about 4.6 to 4.65%. So this is a more normal market with the 10-year Treasury yield over the federal funds rate, but right now they're very close. And of course, this affects the cost of money, despite what the Fed does. The market is driven by Treasury yields as much as it's been driven by the federal funds rate. So let's get into gold. Now, gold has been in 3 consolidation periods in the last year now. Early last year in December, January, February of 2024, as indicated by that oval that's easing out of the picture now. And then again after the run to 24.25 in April and May. And then we've had the big run all the way up to 28.01. And now we're in an ending, I think, our 3rd consolidation phase. And gold is testing the all-time high of 2,800 today as we tape this video. So here is another example of the potential of the Trump administration to move markets. I've got that midterm 2756 high tagged on this chart, and I've got it in purple for a reason. This is because of a surge in the premium in the COMEX exchange in New York over the same value for gold in London in mid-December. Market participants were concerned that if President Trump enacted tariffs on the importation of gold and silver when he took office on January 20th, the premium for physical gold would become suddenly more. And that was anticipated by the markets in mid-December. And that's that puff up over 27.25 at that point in time. Now, this meant that gold was actually moving from London into the US to try and get into the COMEX warehouses before Donald Trump took office. But there's a lot of logistics for time and effort to move metal and freight. It's not a simple thing to do. So that's kind of a flash in the pan, which is why I've shown that. But that shows you how the fear and anticipation of tariffs can move a market. And we've also seen a lot of importers of goods bring a lot into the US going into December and early January, trying to get ahead of potential tariffs and a lot of other commodities and products as well. But now, as we tape this, gold continues to move higher, punching up to 2783 today in the futures market and testing 2801, the previous all-time high. And the market right now for gold is looking very strong, in my opinion. And we could get a breakout in the coming weeks. And that means the run towards $3,000 is back again in earnest. And this consolidation phase that we've been going through since October is coming to a conclusion. That's what appears to be happening, especially if we see more weakness in the dollar and more weakness in Treasury yields. And if we go to the 6-month candlestick chart, you can see that gold has developed kind of a W pattern over the last 4 months, with the peak in late October at 2801, and then President Trump won, and we saw gold sell down to support at 2575, get back into the middle of that range at 2650. We've got that short-term puff up to 2761 intraday due to those fears of tariffs on precious metal importation that I just mentioned. And now, since we've corrected back down to just at 2600 in mid-December, we've seen gold make a steady, solid move higher. Now, as I tape this today, the market is still open, so that very last candlestick to the right is one that I have drawn in to the chart, showing today's market move, which is higher still, taking the intraday move today up to 2794, just under the previous all-time high. And this is a really solid run over resistance at 27.25, and this feels like a real move to me. So it could be corrected down a bit, but gold looks very solid as we move forward. And I would expect to see a test of 2,800 imminently, and then a push higher and potentially to $3,000 before the first quarter, perhaps the first half of the year is over. Gold's had a big gain in 2024. the fundamentals that have driven it higher of US debt, two ongoing global conflicts, inflation, and perhaps an easing dollar and easing Treasury yields are all still in place. So gold is looking very good to me, and I think we could see a breakout any day now to new all-time highs. This is a one-year silver chart. Unlike gold, silver is in a downward easing pattern after going through a consolidation phase, which is essentially began in May. We did get that surge all the way to 35.04 in October, but it didn't hold. Now I've got support at 29 and a quarter, resistance at 32.50, and I've drawn in the blue trend line so you can see, hey, this is an easing trend. Silver is not performing as well as gold has been, and gold, of course, has been leading this whole time. I've got that 32.97 midterm peak in purple for the same reason we put it in purple for gold. That's when we were worried about tariffs for precious metals. Silver's looking pretty good. It's testing that upside resistance right now, which would be at about 31.50 in the futures market and a little bit less in the spot market due to the time value of money between the two. And again, I've drawn that last little black upline in myself today to show you where the market has moved today. It's holding above the 50-day moving average right now, which is potentially bullish for silver moving forward. So silver is cheap relative to gold. Gold continues to lead, and we'll show you why silver is especially cheap right now in just a moment. But first, let's take a look at the candlestick chart. And again, you can see that short-term move to 33.33 intraday was just a couple of days worth of trading, basically 4 before the correction hit in mid-December. Then we tested 29 on the way down where support is, and now we're seeing a pretty solid but modest uptick going forward. And again, I've drawn that last candlestick off to the very right in black. The futures market today is up to about 31.75 and testing upside resistance, as you can see on that blue trend line. So silver is looking good, not quite as good as gold, which means there's more opportunity potentially in silver than there is in gold right now. Let's take a look at the gold to silver ratio chart. With the spot prices today at around 27.75 for gold and 30.75 for silver, that brings the ratio to over 90 to 1 at 90.24 to 1, which means silver is especially undervalued relative to gold right now. For most of the last 3-4 months, it's been in the 82 to 88 range, and silver's just a bit weaker right now with gold leading. So silver looks particularly undervalued right now. All right, so that's our analysis. Let's get on to our specials in precious metals, and we've got a bunch of them. And here's why. During the first Trump presidency, especially in 2018 and 2019, as the U.S. economy continued to respond to Trump administration policies and remained healthy, and gold was under $13.75 and silver was under $18, we had a lot of people become sellers of precious metals, wanting to put money into the U.S. stock markets or other places. The fear factor had left the marketplace, and we were inundated with buybacks as an industry. We're going through a similar phase right now where optimism over the Trump administration and their economic policies are causing people to shed precious metals. Plus, the higher prices are helping as well. But we're getting a lot of product in, not just us as an industry. So there's a lot of deals to be had right now. So we've got 2 in silver with backdated Canadian silver maple leafs and U.S. silver eagles. We've got some of the lowest prices in the country on those. We've got half-ounce U.S. gold eagles on sale, $55 off of their normal premium price. If we had to get them from the U.S. Mint, they'd be a full 4% higher in value than they are today for these backdates that we have available. We also have some Swiss 20 francs at 4% over melt, which is the same premium we're offering the half-ounce gold eagles at. Physical gold doesn't get much cheaper than this, especially for smaller than 1-ounce size coins. And then we've got vintage pre-1933 US $20 St. Gaudens in MS65 condition at $50 off per coin. These are all great deals. So if you're interested in either buying or selling, please give us a call at 1-800-613 9323, or send an email to your account manager or to info@amergold.com. So that's our update. Thank you so much for watching. If you like what we're doing, please subscribe and like this video. We're out there on social media as well: LinkedIn, X, Instagram, American Gold Exchange. And as always, thank you to our loyal clients and supporters for all the loyalty and trust you've placed in us over the last, now going into our 27th year. Without you, we wouldn't have a business, and never a day goes by that we forget that. So thank you so much for everything you've done for us, and good luck as we move into the new year in 2025. And best wishes to President Donald Trump and his new administration in his quest to make America great again. So thank you so much, and have a good day.